Hey, good morning, everyone. Marty Mazzora here. It is Friday, the 6th of June, 2025, with your end of week update. I'm going to jump right into my notes, and we don't need to spend a lot of time on the charts because I just did this for you day before yesterday, and virtually nothing looks different, at least not measurably, versus just a couple days ago. So this morning we got the jobs reports, and it was an important one. I was talking to clients yesterday. I think it could move the needle on stocks, at least for a day, one way or the other, and it's moving the needle higher as I speak. So I think it's an interesting dynamic in the market right now, and as I go through it, I'll offer up some color on the things that are going on there and the implications for the economy. So just in a nutshell, headline payrolls were 139,000. That's 13,000 above expectations, but the prior months were revised down by a total of 95,000. So the overall report is net, and I would say notably softer than it appears. Now, this 139,000 jobs, the headline payrolls, that is from a survey of businesses. They also do what they call the household survey, and this is where they actually get the unemployment rate. The household survey actually said that we lost 696,000 jobs, and the labor force fell by 625,000. Unemployment rate held at 4.2%. The participation rate fell slightly to 62.4, which is the lowest since December of 2022. And prime age, 25 to 54, participation fell to 83.4%. The quits rate proxy, job leavers in the economy, actually fell to 9.8 from 11.8. That's the lowest since May 2021. Actually, when the quits rate is higher, or the job leavers rate is higher, it's considered as a bullish signal about the economy. People don't quit, typically, unless they have something in the offing. So when it drops, it's considered a sign of weakness in the economy. Where jobs came from: education and health, 87,000. Leisure and hospitality, that still is bullish about the economy, up 48,000. Temporary jobs down 20,000. Federal government, Doge cuts, down 22,000. Manufacturing down 8. Construction up 4. Hourly earnings were up 0.4% month on month, which is nice, 3.9% year on year. Steady work week, 34.3 hours. Average weekly earnings up 0.4%. Labor market strains, 199,000 jobs from the birth-death model. The birth-death model is interesting because where it's derived from is the birth versus deaths of companies. Essentially, new companies opening and others closing. The headline number just simply can't capture the businesses closing because you're not going to be able to survey those because they're no longer there. And they won't necessarily be calling businesses that just got started, right? So essentially it's an estimate using historical patterns. Doesn't really reflect current economic conditions, so it's a bit ambiguous, but they use it. And the 199,000 jobs is quite likely, or at least potentially, an overstatement. Part-time for economic reasons, this is definitely a sign of weakness or stress in the labor market, because these are folks who, to the tune of 125,000 last month, who would prefer to be working full-time, but because of the economy, presumably, they can only find part-time work. And then the trend averages: 3 months, 135,000 new jobs; 6 month, 157; 12 month, 144. Growth trend clearly slowing. So the labor market snapshot, early June, right? And notice AI generated, folks. Yes, we are definitely incorporating artificial intelligence into our own work. And as you can see here, it helps us distill data. We'll still read reports, of course, and so on, but it is nice to be able to just distill it to the key bullet points, and certainly when it comes to articulating succinctly what's going on to clients. So essentially, what does the higher frequency data tell us about the current backdrop. 247,000 initial jobless claims was above expectations. 4-week average, 235,000, highest since October 2024. Continuing claims, 1.9 million, near 2021 highs. You see this highest and then near highs and so forth. These still are not scary recessionary numbers by any stretch, but we do want to look at trends as they develop, and the trends are slightly going in the wrong direction. As for Challenger job cuts report, job cuts, layoffs, firings, what have you, were up 47% year over year. Tariffs, funding cuts, weak consumer spending, and economic pessimism were the reasons. Top layoff reason was the Doge impact, still leading in 2025. Other reasons, poor economic conditions and closures. These are the reports from the companies who are laying people off. Hiring plans, however, were up 57% year over year, but that's still historically low compared to the pre-pandemic norms. The Fed Beige Book, which we're going to run through here in a second, says the labor market was flat to soft. Widespread hiring delays, reduced hours and overtime, and scattered layoffs, weak labor demand across most or all sectors. Worth noting that container shipment prices are suddenly screaming higher again. Again, not a good sign relative to the costs of goods that are coming from China to the U.S. Now, the Beige Book. The Beige Book is a survey of all 12 districts that the Fed covers, and this is an important one to look at. It's pretty detailed. Here is the kind of the summation, if you will, or the key takeaways. Bottom line is the Fed Beige Book shows a stagnating U.S. economy. Half of the districts reported declines, others flat to slight growth. Businesses and households are hesitant due to high uncertainty. Manufacturing says slight decline. Consumer spending mostly flat or down, except where tariffs prompted early buying. So again, that pull forward due to tariffs. Housing flat or slowing, construction and sales. Bank loans and capital spending mixed. Employment flat with signs of weakening demand and some layoffs. Tariff impact, costs are rising. Businesses expect faster price increases, mainly from higher tariffs. Companies are raising prices, accepting lower margins or adding surcharges. Port activity is up due to pre-tariff shipping. I think hence that price rises I just showed you on containers from China. Other transport sectors are mixed. Outlook, a murky economic picture with rising cost pressures likely puts the Fed in a bind. And the Fed bind would be the economy appears to be beginning to show signs of weakness or continuing to. That could very well accelerate as we get into the year. That's our concern over recession. But cost pressures, i.e. inflation, right, or the potential for that, has them kind of in a bind. Interestingly, the president this morning, I saw the headline, he is pushing the Fed, they say Powell in particular, to cut interest rates by a full percentage point. And here's that conundrum I keep talking about, that rock and a hard spot narrative, right? Until we actually see the economy really begin to slow, and definitely there's some weakening there, I actually sympathize with the notion that the Fed is going to need to cut interest rates as we get further into the year. Some of this data, or most of the data I'm showing you here, says, yeah, that's probably pretty likely because the economy is going to continue to weaken. But if you put a big interest rate cut cart before the horse, so to speak, you're going to have a problem. You're going to actually have interest rates go the other direction, I'm quite certain, like they did last September when the Fed cut 0.5 point. Mortgage rates went up 1 full percentage point. Right here, you see a better than expected jobs number, and bonds are getting crunched today, and yields are going higher. You throw a 1% rate cut on top of that right here, which they're not going to do, by the way. But if you did, you would have the opposite impact that I believe the president would be hoping for. His advisors are probably looking at this and saying, we've got issues, and the Fed could help. They can definitely cut interest rates, but that could spark inflation if they do it too soon. When the economy begins to contract, which it will. I mean, I had a good friend of mine say yesterday, everybody's been calling for a recession and it just never seems to come. Well, reality of it is it will. It's still a cyclical economy. It's just, when will it happen? As I said Wednesday, the video you got yesterday, we were all in that camp that there should be a recession in 2023. And I explained why we believe that didn't happen. Doesn't mean it's never going to happen just because it didn't happen in a year where virtually everybody expected it. Still, we're going to get a recession. We're going to get a slowdown. The question is the timing of the response to it. And the Fed is in a tough spot right here. Their hands are kind of tied. And if they got too aggressive too early, it's going to be problematic. Imagine that happening right when we get, tax cut extensions and further tax cuts, what that might do to inflation if indeed the economy, the hard data, really isn't showing signs of weakness. And then lastly, in terms of the notes today, the following is something that we've been anticipating and allocating for, hence our notable outperformance so far in 2025. Clients, I know you've noticed how well your portfolio has done this year, where most of the year U.S. stocks have been down. They're now up with today's move. The S&P's up about 2% so far this year, and you're up significantly more than that. Well, big reason for that is what I've been illustrating for you for at least the last year, and that's the massive mismatch between valuations in the U.S., which are really at all-time record highs, and the rest of the world. The relative mismatch has been enormous, and it really didn't matter ultimately the trade war in our view or whatever was going to happen in 2025. It's just that the setup for non-U.S. versus U.S. was extremely favorable to non-U.S., and I think that's going to be the trend for quite some time going forward, save for periods like last month where U.S. stocks did really, really well. We'll definitely get these bounces. But from the levels that I've continued to illustrate for you, and I don't have that loaded up today, but we'll be looking at that a lot. From these levels of valuations, the forward potential for sustainable growth or outperformance in U.S. equities is just not there, historically speaking. But I did say, and I said it, I think, video before last, that it's a completely headline-driven market. And in a headline-driven market, despite valuations and the fundamentals, 100% stock could easily scream to new all-time highs. The question is, should you be riding that train? Is it sustainable? And those are huge questions right here. But absolutely, in an emotionally driven market after being down 20% in 6 weeks earlier this year, absolutely, you can get animal spirits come screaming back into big U.S. tech stocks. Our job is to make sure that whatever we do has, sustainability behind it. And that's the key question right here. And there's lots of reasons why you would think that maybe not in terms of the most recent rally, and I'll show you the charts here in a second. So what this says, and I just pulled from a Bloomberg article, is that non-U.S. assets are in demand as global allocation reset begins. Shift underway. Investors are starting to rotate away from U.S. assets, rethinking American exceptionalism as global diversification becomes more appealing. Again, this is something that we were highlighting at least a year ago. Context: over the past decade, U.S. equities, especially tech, have dominated portfolios due to strong growth and returns. That trend is now under scrutiny, and I think rightfully so. J.P. Morgan says investors, including hedge funds and family offices, are actively seeking alternatives. Emerging favorites, China, Japan, and select emerging markets are gaining interest. Now, I think they're gaining interest right now because those haven't been, they've done fine, they've outperformed the U.S., but it's been, Europe, developed Europe, that's done incredibly well so far this year. So I think maybe they're thinking that's, getting a little long in the tooth, and maybe they should be looking at Asia. I love that, that we're in all these spots, and I'm going to show you some year-to-date results here in a second. Broader implication, U.S. markets, or the dominance of them, is no longer a given, and that just makes sense. It's not a statement against our country or the opportunities. It's clearly a statement of economic and market fundamentals right here. And where, when I say economic, where we are on timelines, ECB just lowered interest rates again, but they say that they're near the end of their rate cutting cycle. And the U.S. really hasn't even begun a rate cutting cycle yet. So that suggests that there are different spots in the economic cycle. And then, of course, again, as I keep repeating, there's that huge valuation mismatch as well. Okay, so let's just do a quick look at the charts. And like I said, we can almost skip this one, but we won't. So Oh, before I get there, just a look at what I was just talking about, and that is the year-to-date performance, starting with the S&P. And again, this is with today's move, which is up like 1%. So it's up about 2% on the year. However, the Europe, Australasia, and Far East Index is up 18.5%. Europe, the Eurostoxx 50, is up 25% year-to-date. Developed Asian markets, this is a lot of Japan, is up 12.5%. Emerging markets up 9%. The Dow Jones Industrial Average up 0.3%. It's just moving into the green today. The New York Stock Exchange Composite, which also has foreign traded stocks, ADRs, in the U.S., is up 5%. Latin America is up 21.5%. The NASDAQ Comp is up 1%. The S&P Equal Weight is up about 1%. And small cap U.S. stocks are still down nearly 5%. So here's what I'm talking about. As you can see, massive outperformance of non-U.S. versus U.S. So anybody who's got a globally diversified portfolio in equities, and we are real close to 50-50 split between U.S. and the rest of the world. So most U.S. investors are going to have much more U.S. exposure than that, but we've been migrating to that. That explains a lot of this year's notable outperformance, as well as, gold being up a bunch. Silver's had a really nice run. So we have other things outside of equities that are doing well for us this year as well. But anyway, for today's purposes, I just want to emphasize how well, at least so far, and we're taking nothing for granted, this can all change, how well non-U.S. has outperformed in terms of equities. Okay, so back to the U.S., the S&P 500. This is just, again, we're getting that really nice boost today, and presumably it's on that jobs number. There is nothing that looks very good to me right here if you're thinking beyond just today, right? That's a rising wedge pattern. That's a negative divergence in momentum. We shall see, but this tells me that's likely, odds favor, lots of resistance to come here in the next few weeks. But, of course, news, and like I said, conversations, I guess the president says he's going to China. And remember I said last time, just conversations right now could ignite animal spirits. Again, this is a headline-driven market if I ever saw one. Same chart, essentially, on the daily for the NASDAQ 100 index. You can see, looks like today it's coming off the boil. Still nicely higher, but coming down a little bit here intraday. The dollar is having a nice boost today, right, on that jobs report, and interest rates rising. So we're still in a real downtrend in the dollar. I talked yesterday about an analysis or a debate that I listened to yesterday morning where the economists were pretty much split in terms of the short run, whether the dollar is going higher and lower. The whole team, though, is bearish the dollar like we are over the next few years. And again, I said on yields, remember I said this bull flag that probably I should just ghost that because I think this flag is too big, but we are breaking out to the upside today. And again, so that's yields going up on, at least on the surface, looks like optimistic economic news. So you start getting yields back up into this territory, and this is where stocks get into trouble. So if the Fed actually did cut interest rates and boost animal spirits that way, the president's big bill, which is more deficit spending, that would be short-term good for the economy, perhaps. You got to be careful. You don't want to throw too much gasoline on this fire because rates could go a lot higher if you do. And then gold. Remember, I said gold is really remarkable. After I ran that last video, I do this yellow rectangle right here, which is just this real trading range that gold is following, and it's down a pretty good chunk today, breaking down below that rising wedge pattern. I think gold can go quite a bit lower before it goes higher. We own a good chunk of it, and we're going to continue to. We're very bullish, as I keep saying, in the long run. Short run, particularly if stocks start threatening those new all-time highs, that's probably a backdrop that where gold would suffer, because a lot of this is geopolitical angst that's in that price right here. Longer term, there's much more to the gold trade, we think, than just the geopolitics. So folks, I'm stopping right there. Hope you have a great weekend. Appreciate you, as always, for watching and listening, and we will for sure be back next week. Take care. Thanks again. Bye-bye.